So, when you first glance at TD Bank's latest quarterly report, things look pretty strong. But when you dig just a little bit deeper, you find this really fascinating story. It's almost a tale of two banks in one. You've got this incredibly powerful profit engine on one side, and it's funding a massive, really expensive overhaul on the other. Today, we're going to break down exactly how these two stories are shaping the future of one of North America's biggest banks. All right, so here's our game plan. First, we'll look at that big, flashy headline number. Then, we're going to pull back the curtain and see what's going on with the adjustments. After that, we'll dive into the huge repair job the bank is dealing with, check in on how the core parts of the business are actually doing, and then we'll wrap up by looking at what risks are on the horizon. And here it is, the number that gets all the attention. Nearly $3.3 billion in net income for just one quarter. I mean, by any standard, that sounds like a fantastic result. But as you're about to see, that number, it's not the whole story. Not by a long shot. Yeah, so that's the real question, isn't it? Because with any financial report, you have to ask, is this number showing us how the business is really doing day to day? Or are there some unusual, one-off things kind of skewing the picture? To figure that out, we have to look at something called adjustments. And that brings us right here. To really get a good feel for a company's health, you have to look past that official reported number to what are called adjusted earnings. It's all about getting a clearer view of the core business. So let's break that down. So what in the world are adjusted earnings? Well, think of it like this. It's the profit number you get after you strip out any weird one-time costs or gains that aren't part of the normal business. The whole point is to show you the company's true ongoing earning power, without all the noise.
And for TD, wow, this makes a huge difference. The reported income, the one everyone sees first, was about $3.25 billion. But once you add back more than $500 million in these special items of note, their adjusted income jumps up to almost $3.8 billion. That is a massive gap.
And you can really see that gap plain as day right here. The official reported number is on the left, but the bank's actual core performance, that's the adjusted number on the right, is way stronger. This tells us that some major one-time costs were dragging down that official result. So, what were they? Well, here are the main culprits. The biggest hit was $333 million for restructuring, things like severance pay, closing offices. Then there was another $262 million spent just reorganizing their U.S. balance sheet. Now, these are real important expenses for sure, but they're not part of the day-to-day business of taking deposits and making loans. But beyond all those accounting charges, there is a much, much deeper challenge happening. The bank is in the middle of this massive project to fix its anti-money laundering systems down in the U.S. And believe me, for the folks in the corner office, this is priority number one. Okay, so this is the absolute crucial point. TD reached what they're calling a global resolution with a whole bunch of U.S. regulators. We're talking the Department of Justice here, over some very serious failures in their programs designed to stop financial crime. This is a big deal. Now, for anyone who's not familiar, BSA/AML basically refers to the laws that force banks to be the front line of defense against things like money laundering and terrorist financing. They have to know who their customers are, monitor all the transactions, and report anything that looks suspicious. And TD had to admit its programs just weren't cutting it. So what's the plan to fix it? Well, it's actually a really clear four-part plan. First up, they're tightening the controls on any new business they take on. Second, they're giving their investigators better data and tools to work with. Third, they're rolling out specialized training so employees know what to look for. And finally, they're bringing in modern tech, like machine learning, to help automate the hunt for financial crime. And make no mistake, this is a marathon, not a sprint. The bank has laid out a multi-year timeline. All of 2025 is just about laying the foundation, figuring out what went wrong and designing new policies. 2026 is where the really heavy lifting happens. And 2027 is all about making sure these new fixes actually stick. This is a massive, complex, and very expensive undertaking. Okay, so with all this focus on a huge, costly cleanup, you might be wondering, how is the actual business of banking doing? Is the rest of the company okay? So let's pop the hood and take a look at how TD's main divisions are performing. And this is where the story gets really interesting. While all those AML issues are grabbing the headlines, the bank's core profit engines are just firing on all cylinders. I mean, look at this. Their Canadian banking income is up 4% to almost $2 billion. Their wealth and insurance business is up an incredible 30% for the year. Even the money they have to set aside for potential bad loans went down, which is a really good sign. So, what this really tells us is that TD is living a double life right now. On one hand, it's got this huge, expensive problem to fix in its U.S. compliance operations. But on the other hand, its foundational businesses, especially back home in Canada, are incredibly strong and are basically generating all the cash needed to fund those repairs. And finally, every quarterly report doesn't just look backwards, it also looks to the future. So what are the big external risks that are keeping the bank's leadership team up at night? Looking ahead, the bank is really keeping its eye on four main things. First, geopolitical and trade uncertainty, which could slow down the whole economy. The regulatory environment in the U.S. is obviously a huge focus. And then you have the constant threats of cyber attacks and, well, financial crime itself. Those are always top of mind. So, in response to all these risks, the message from the top is one of calm and stability. The CEO, Bharat Masrani, points to the strength of our business model as the key to getting through any challenges. You know, it's that classic leadership message. We see the storm clouds, but don't worry, our ship is strong enough to handle it. And that right there brings us to the final, central question of this whole report. It really all boils down to this one thing. Is that profit engine from the bank's healthy businesses powerful enough to pay for this massive, multi-year repair job without stumbling? That's the tension, that's the story everyone is going to be watching for many, many quarters to come.
Okay, let's unpack this. We're diving deep into the TD Bank Group third quarter 2025 report to shareholders. And this isn't just, your standard earnings call rundown. This report, it really maps out a period of massive internal cleanup, some major balance sheet surgery, and a pretty big strategic pivot. It seems like they're moving away from pure expansion toward, well, maybe operational purification. So our mission today: distill the key financial moves, understand the operational health, and figure out what really matters to you, the stakeholder.
Absolutely. And what's really fascinating here, I think, is that this particular quarter forces us to look past just the surface numbers. To truly get a handle on the bank's health, we absolutely have to look at both sides, the reported numbers and the adjusted numbers. Because this quarter, it was really defined by that huge one-time gain from the Schwab investment sale finally wrapping up.
Yeah.
But also by the ongoing, very expensive shadow of the U.S. Bank Secrecy Act and anti-money laundering compliance issues. The BSAL remediation is kind of the difference between the headline news flash and, the actual reality check sitting on the CEO's desk.
Okay, so let's start right there with those headlines to really show that contrast you mentioned. Reported net income for Q3 2025 was $3,336 million. I mean, on the face of it, that looks like a massive win, right? Especially compared to the reported loss of $181 million from Q3 2024. But you're saying that number might be a bit misleading.
Well, yeah, potentially. That sharp rise, it's certainly positive, don't get me wrong, but it largely reflects some temporary benefits or, specific accounting treatments. The real measure, the underlying pulse of their successful ongoing business, that's the adjusted net income. And that's slightly higher, actually, at $3,871 million for Q3 2025. See, when we talk adjusted figures, we're basically stripping out the noise, things like merger costs or big one-off gains to get a clearer picture of the core operations.
Right, the underlying engine. And speaking of big one-off gains, we really have to put Q3 in the context of Q2, don't we? Because just the quarter before, Q2 had this massive reported income, over $11 billion. Where did that astronomical figure come from?
Yeah, that staggering number. It was driven almost entirely by the sale of their remaining stake in the Charles Schwab Corporation. That happened back in February 2025. That single transaction recognized a net gain on sale of roughly $9.2 billion. It was a massive financial windfall.
Okay, $9.2 billion. And what did that huge capital injection actually do for the bank? I mean, beyond just making the net income look incredible for one quarter.
Well, crucially, it gave them an enormous cushion, a huge capital injection, really exactly when they needed it most. Needed it why? To absorb these future cleanup costs and potential fines we're talking about. Our sources note this sale boosted their common equity tier 1 ratio, the CET1 ratio, which is, the key measure of a bank's financial strength. It boosted it by about 238 basis points in Q2 2025.
Wow.
Yeah, that's not just a small bump. That's the kind of massive capital boost that gives the bank breathing room to navigate what looks like years of expected regulatory remediation and cleanup costs. That capital boost is absolutely key to mitigating the risks that are playing out right now.
Okay, so the overall institution is navigating this internal turmoil and shuffling capital around. Is there any part of the bank that's actually managing to hold the line and grow organically? Where's the growth engine running right now?
The sources, they clearly point north. Canada is absolutely the operational success story for TD right now. The Canadian Personal and Commercial Banking segment, or PNC, delivered record revenue, $5,241 million, up 5% year over year. And record net income too, $1,953 million, up 4%. That engine is primarily fueled by just solid loan and deposit volume growth.
And even their core profitability measure, the net interest margin, or NIM, showed stability there. It increased 2 basis points to 2.83%. So steady, very successful performance in Canada. It's kind of acting as the anchor for the whole group, isn't it?
Exactly. Now contrast that with the U.S. retail segment. That division is effectively undergoing, financial surgery. This segment is under tremendous pressure, and it's the middle of significant balance sheet restructuring. Why? Because of external limitations. Limits placed on the combined total assets of their U.S. bank subsidiaries. They literally have a cap imposed by regulators on how big certain parts of their U.S. business can get.
Okay, that's the critical why that sometimes gets buried. Why are these external limits suddenly forcing them to shrink and sell assets? What specific regulatory failure led to this asset cap?
Well, this cap is part of the fallout from their compliance failures, specifically around the U.S. Bank Secrecy Act and anti-money laundering programs we mentioned, the DSAML stuff. By capping asset growth, regulators basically forced the bank to focus resources internally, focus on fixing the fundamental governance and risk management problems. Rather than just chasing volume growth. They kind of have to shrink before they're allowed to grow safely again.
And that shrinking, it came at a real pretty painful cost, didn't it? Since that initial restructuring was announced back in October 2024, right through Q3 2025, the bank sold off about US $25 billion worth of bonds from its US investment portfolio. That sounds like a controlled demolition.
It essentially is. They're intentionally selling assets, often at a loss, because the cost of not meeting those regulatory mandates is actually far higher in the long run. So that US $25 billion in sales, it resulted in an aggregate pre-tax loss of US $1.3 billion. And in Q3 specifically, they sold another US $5.9 billion of bonds, booking a US $244 million pre-tax loss for that. Plus, they reduced loans by another US $4 billion, mainly through runoffs and sales in what they call non-core US loan portfolios.
Yeah, it's jarring to read that a bank is willingly taking a, $1.3 billion bath like that. But you mentioned a strategic uplift in profitability came out of this. How can taking massive losses actually lead to better profitability metrics? That seems counterintuitive.
It really does. But it's the definition of a strategic paradox, maybe. Despite those upfront losses, the U.S. retail net interest margin in the NEM, how much they make lending versus paying on deposits, it actually increased sharply, of 17 basis points to 3.19%. This reflects the intended impact of that restructuring. They sold lower yielding, maybe less strategic bonds and loans, and effectively replaced that funding with higher margin deposit funding. It repositioned the portfolio for better long-term profitability within those asset limit constraints.
Okay. So they're using the crisis in a way to get leaner and maybe meaner. And part of that involves shedding certain niche businesses that maybe don't fit the new, more focused approach.
Correct. The strategic decision was made to gradually wind down their point-of-sale financing business. That's about a US $3 billion portfolio servicing third-party retailers. This aligns with the new focus on core, non-niche portfolios. Those are often, frankly, easier to manage from a compliance and regulatory perspective.
Okay, let's shift gears slightly and talk about the elephant in the room. The massive task of regulatory remediation itself. This is that deep cost of compliance we touched on earlier, mandated by the Global Resolution from October 2024 regarding the U.S. BSAML programs.
Yeah, this is really the centerpiece of their strategy right now. They are laser focused on meeting the terms of those consent orders and the pre-agreements. And the expected investment, it's huge, and it spans years. The bank continues to expect a US $500 million pre-tax investment in just the remediation and related governance and control work in fiscal 2025. And they expect similar levels of investment again in fiscal 2026.
$500 million US annually just for cleanup and compliance. Wow. That kind of figure really signals a massive multi-year shift in their strategic priorities, doesn't it? Is this timeline for getting it fixed unusual?
Not necessarily for the scale of issue, but the multi-year aspect is absolutely key to understanding the commitment involved. Significant work is planned for calendar 2026 and 2027. They're specifically targeting completion of the suspicious activity report lookback. That's where they have to retroactively check past transactions for calendar 2027. That's required by the OCC consent order. So yeah, this isn't a quick bandage. It's more like a multi-year surgical reconstruction of their internal processes. But they are showing some tangible progress in Q3, right? Yeah. Suggesting the money is actually being spent effectively. They did highlight that. Specifically, the deployment of the first phase of machine learning analysis for transaction monitoring. That's actually a significant step because modernizing systems, using tools like machine learning, should help them improve both the effectiveness of their compliance checks and hopefully the efficiency of their operations going forward.
Right, that's the critical link, compliance driving efficiency, which ties directly into that broader internal restructuring program they kicked off in Q2 2025, the one aimed at aggressively reducing their cost base across the entire organization.
Absolutely. They're spending heavily in one area, compliance, but also looking to save heavily overall. They expect to incur restructuring charges of somewhere between $600 million and $700 million pre-tax over several quarters for that broader efficiency program.
Okay, that's another major outlay then. So what's the expected return on that internal restructuring spending?
Well, the reward, once it's fully realized, is expected to be significant annual savings, somewhere between $550 million and $650 million pre-tax. And critically, that figure includes savings they expect from an approximate 2% workforce reduction. So it's an intensive, high-cost effort really to streamline operations globally while at the same time reinforcing governance and controls. They're basically paying a hefty price now to hopefully be more secure and efficient later on.
All right, let's pivot now to the bank's overall financial resilience. Despite these planned losses and massive cleanup costs, their capital health actually looks exceptionally strong, largely thanks to that Schwab sale we talked about earlier, right? Their main financial safety net, the CET1 capital ratio, stands at a pretty formidable 14.8% as of July 31st, 2025.
Yeah, that is a substantial cushion. Remember, their regulatory minimum target is 11.5%, so 14.8% gives them a huge margin of safety. It's kind of the financial equivalent of wearing, 3 safety nets while walking a tightrope.
Right.
It means they can absolutely weather these planned losses and cleanup costs without any real worry about stability. Their liquidity position also looks rock solid. The average liquidity coverage ratio, or LCR, was 138% for the quarter,
right,
well above the regulatory requirements.
Okay, but we did see a $15 billion decrease in their unencumbered liquid assets since October 2024. Does that signal any kind of stress?
The sources indicate this was entirely planned, actually. They were actively managing down the elevated liquidity surpluses that they had right after the Schwab sale, managing them down to more sustainable, normal levels. So it's not really seen as a sign of stress. It's more like a planned normalization. They just had too much cash sitting around post-sale and decided to deploy it or normalize it.
Got it. Now, on to credit quality, always a key indicator of underlying economic stress, especially now. The total provision for credit losses, the PCL, for the quarter was $971 million. That's actually down slightly from $1,072 million in Q3 2024.
Yeah, that slight decrease looks positive on the surface. But if we dig a bit deeper into the risk profile, the Stage 3 allowance for loan losses, those are the impaired loans, the ones they really don't expect to get fully repaid, that did increase, up by 2% compared to the prior quarter. And this reflects what they call credit migration, particularly in the business and government lending portfolios.
Okay, so translating that from bank speak, the increase in Stage 3 allowance means more commercial customers, specifically businesses and government clients, are moving from maybe potentially late to definitely impaired.
Precisely. And that's a classic sign of economic slowdown stress starting to hit the commercial side, not just the consumer side. So while the overall provision number looks slightly better year over year, the internal quality of the loan book is showing some pockets of weakness that they'll need to monitor very closely.
Okay, finally, let's touch on the TD economics forecasts. These provide that crucial macroeconomic backdrop for all these strategic moves. What are they projecting for the U.S. economy? That's where all this costly cleanup is happening.
Right. For the United States, TD Economics expects growth to slow down considerably, coming in below a 2% pace over calendar 2025. And they anticipate the Federal Reserve will likely resume monetary easing, cutting rates. They see the federal funds rate potentially reaching 3.50% to 3.75% by the end of calendar 2025.
And what about the forecast for the bank's anchor segment, their strongest performer, Canada?
The Bank of Canada is also expected to continue trimming interest rates. TD Economics projects rates reaching 2.25% by the end of calendar 2025 in Canada. So both forecasts point towards, overall economic tempering and future interest rate cuts, which of course impacts the bank's net interest income projections because lower rates typically mean lower margins over time.
So putting this all together for you, the listener, the TD Bank Group right now, it's really a story of robust stability driven mainly by its Canadian strength, which is essentially compensating for a very complex, very costly strategic pivot happening in the U.S. They are cleaning house, deliberately shrinking some assets at a loss, and completely resetting their compliance standards south of the border.
Yeah, the core strategy has shifted dramatically, from seeking large-scale external growth like acquisitions to focusing on rigorous internal governance and operational efficiency. That BSAML remediation costing U.S. $500 million plus annually, stretching out to 2027. That is the dominant multi-year factor driving strategy right now. And it's consuming a lot of the capital that was generated by that big Schwab sale.
It truly is a massive pivot from outward expansion to, inward purification and structural change.
Absolutely. And we've seen here the sheer power of these financial giants to generate enormous one-time gains like that $9.2 billion from Schwab, but also how those gains have to simultaneously absorb monumental structural costs like the U.S. balance sheet losses and these multi-year compliance investments, all just to meet strict regulatory and strategic demands.
Which really raises an important question for you to think about. Given this backdrop of predicted slowing economic growth and those anticipated future interest rate cuts, how much internal restructuring capacity does a major bank like TD need to maintain just to manage regulatory compliance and asset limits rather than focusing purely on maximizing organic growth? That's the big strategic trade-off they seem to be carrying into the next fiscal year.